Welcome, investors, to this comprehensive analysis of one of the most significant events shaking financial markets and Silicon Valley in 2025, the collapse of big tech stock prices and why Silicon Valley CEOs are deeply worried. This downturn has sent ripples across the global economy, impacting portfolios and prompting a re-evaluation of long-held investment strategies. In today's video, we'll dive deeper into the causes of this unprecedented downturn, the resulting market impacts, how top executives are responding to these challenging times, and what the future could hold for these tech giants as they navigate a new economic landscape. We will explore the intricate web of factors contributing to this shift. Over recent months, major technology companies like Apple, Microsoft, Nvidia, Meta, Amazon, and Alphabet have experienced significant stock value declines. These declines are not isolated incidents, but rather part of a broader market correction affecting the entire tech sector, leading to substantial losses for many investors. Microsoft shares dropped by over 8.6%, wiping out roughly $350 billion in market cap, a staggering loss that highlights the volatility. Meanwhile, Nvidia, a leader in the booming AI space, faced sharp pullbacks after initial exuberance, demonstrating that even market leaders are not immune to these pressures. This turmoil has been a driver of major indexes like the Nasdaq and S&P 500 falling in recent weeks, signaling a broader market correction. So what exactly is causing the big tech stock collapse? Let's explore the underlying factors contributing to this significant market shift. The situation is complex, involving several interconnected factors. First, let's discuss the AI bubble concerns. Artificial intelligence is at the forefront of technological innovation, attracting massive investments and driving sky-high valuations. But this rapid growth also brings inherent risks. Yet many AI startups and established players are still struggling to become profitable, sparking fears that current stock prices may not reflect realistic near-term earnings. This struggle for profitability raises questions about the sustainability of current valuations and the long-term viability of some AI ventures. High operating costs for research, development, and infrastructure squeeze profit margins, meaning expectations might outpace actual financial results. The substantial capital required to innovate and scale in the AI sector often creates a disconnect between investor optimism and immediate financial returns. Analysts warn this could result in a substantial market correction reminiscent of the early 2000s dot-com crash. The parallels between the current AI boom and the dot-com bubble are a cause for concern, prompting investors to exercise caution and scrutinize valuations more closely. Secondly, we face geopolitical and regulatory headwinds. Rising geopolitical tensions and protectionist policies are weighing heavily on investor confidence, creating an environment of uncertainty that impacts global markets. These external pressures add another layer of complexity to the tech sector's challenges. Trade disputes, sanctions, and export controls, particularly between the US and China, disrupt supply chains and limit technology flows. These geopolitical frictions create significant operational hurdles for tech companies, impacting their ability to produce and distribute goods globally. Meanwhile, evolving regulations on data privacy and AI use in key markets like the US and Europe impose compliance costs and operational challenges, injecting further uncertainty. These regulatory shifts require significant adjustments from tech companies, often leading to increased expenses and slower innovation cycles. Thirdly, we observe investment pressures and margin compression. Tech giants are investing billions to scale AI infrastructure, cloud services, and data centers, often faster than purchaser demand grows. This aggressive investment strategy, while forward-looking, can strain immediate financial performance. This mismatch exerts pressure on profit margins, creating doubts about short-term financial sustainability despite robust revenue growth. The rapid expansion of infrastructure without a proportional increase in demand can lead to underutilized assets and reduced profitability. The gap between soaring capital expenditures and near-term profit growth is a source of concern for investors wary of stretched valuations. This imbalance suggests that while companies are investing heavily in future growth, the immediate returns may not justify the current stock prices. Fourth, we delve into Silicon Valley CEOs' existential worries. beyond market risks. Reports indicate many Silicon Valley leaders are prepping for extreme scenarios, including economic downturns, geopolitical crises, or environmental disasters. This level of preparedness reflects a deep-seated anxiety about systemic vulnerabilities. Investments in luxury survival bunkers reflect profound fears about broader system fragility, extending concerns well beyond business fundamentals. This trend among tech elites underscores a growing apprehension about the stability of global systems and the potential for widespread disruption. Finally, we see a shifting investor sentiment. Consequently, many investors are reducing exposure to high-risk tech stocks, particularly those heavily dependent on AI's uncertain future. This shift indicates a move towards more conservative investment strategies in response to market volatility. Even though the broader market index shows gains for 2025, the tech sector heavily drags on short-term market performance. This divergence highlights the unique challenges faced by the tech industry, even as other sectors may be experiencing growth. Market volatility remains extreme, even as companies like Alphabet and Nvidia maintain positive year-to-date returns. The Nasdaq recently posted its worst weekly drop since April 2025, with numerous big tech stocks experiencing double-digit losses. This downturn is pulling major indexes away from all-time highs, with technology stocks heavily influencing the market's overall performance. Even established players like Microsoft have experienced declines, alongside significant reversals for companies such as Palantir Technologies and Nvidia, despite strong performance reports. Executives are navigating a difficult landscape, pushing forward with AI investments while managing cost pressures and softer demand. Microsoft CFO Amy Hood recently highlighted the infrastructural strain as demand outpaces capacity, tightening margins and complicating near-term forecasts. Simultaneously, some executives continue prepping for broader systemic risks by enhancing crisis shelters, signaling heightened anxiety that transcends corporate earnings. Investor views diverge sharply. Some dismiss bubble fears as exaggerated, whereas notable investors like Michael Burry are openly betting against big tech. Burry cites inflated valuations and questionable business models portending a severe correction, highlighting the uncertainty surrounding the future performance of these stocks. A significant portion of this anxiety stems from massive capital expenditures on AI infrastructure, with big tech's spending expected to surpass $200 billion by 2026. Companies like Amazon, Microsoft, and Google are heavily investing, but investors are becoming impatient, wanting concrete evidence that these investments are generating measurable improvements. Concerns are rising over corporate debt and the efficiency of AI spending, with some analysts suggesting the current sell-off is more about valuations and sentiment than systemic risk. The current environment calls for prudence and diversification. While big tech remains pivotal to global innovation, it is no longer a guaranteed safe haven for short-term investment. Minimizing exposure to volatile stocks and rebalancing portfolios toward more stable sectors can help mitigate risk. Diversification across various asset classes, sectors, and regions is crucial to reduce exposure to any single asset or risk. Investors should consider sectors like healthcare, biotech, green energy, consumer staples, and defense and security for more stability. Strategies such as sector-based, geographic, asset class, time-based, and risk profile diversification can be employed. Exchange-traded funds, or ETFs, offer built-in diversification by pooling multiple assets, providing an accessible option for many investors. Staying informed not only on earnings, but also geopolitical and regulatory shifts will be critical for navigating this complex landscape. Despite 2025's challenges, big tech will continue shaping the digital economy, with investment in AI, cloud technology, and innovation not slowing down. However, market participants will demand greater business model sustainability and transparency from these tech giants. The coming years could transform tech leadership dynamics, introducing new players and geopolitical alignments that redefine global tech power structures. Companies that can demonstrate concrete efficiency gains and revenue growth from their AI investments will likely see their massive spending validated. Investors can also consider a low net long/short strategy, involving both long and short positions to balance market exposure and capitalize on movements. A resilient approach to investing in the tech sector can diversify while providing a buffer against drawdown and concentration risk. Founder-led companies, driven by long-term vision and operational discipline, have historically outperformed in volatile environments. Alternative investments, such as private credit, private equity, and real estate, can also be considered to further diversify portfolios. Warnings from Wall Street executives about potential market corrections have influenced the market, with chiefs from Capital Group to Goldman Sachs noting a pullback as healthy. The CBOE Volatility Index, or VIX, a barometer of market fear, surged to 20.8 in 2025, reflecting heightened market anxiety. Some analysts suggest that the main cause of the stock market's wobble is declining financial system liquidity, which can be tracked via the performance of Bitcoin. In summary, the collapse of big tech stocks in 2025 is driven by a combination of factors, including AI bubble fears, high valuations, and macroeconomic uncertainties. Investors are advised to adopt a cautious approach, diversify their portfolios, and stay informed about market developments. The future of big tech remains uncertain, but companies that can demonstrate sustainable growth and profitability are likely to thrive in the long run. Thank you for watching this deep dive on the collapse of big tech stocks. Why are Silicon Valley CEOs worried? If you found this video valuable, please hit the subscribe button so you don't miss future updates. Stay tuned for more insights to help you navigate the evolving investment landscape. Happy investing, investors!